Our guest this evening is Charlie Mann of Trinity Wealth Management. Welcome, Charlie.
Hello, Charlie.
Thank you for having me.
Good to see you.
Good to see you.
So, for the benefit of our advisors and a good place to start, can you give us a brief background of Trinity Wealth Management?
Sure. So we are what's called a registered investment advisor, and we're a fee-only advisor, which means that we're getting paid for our advice and not getting paid to sell financial products. We primarily work with individuals and families that are approaching retirement, and we help them plan for their retirement, and then we manage their investment assets to help make sure that they make it through their retirement. And so that's primarily what we do at Trinity Wealth.
And you do that primarily in the Delaware Valley area, Charlie?
Yes, so we're located in Berwyn, and most of our clients are in this area. We do have some clients that were here and have moved outside of the Philadelphia area. So we have some clients all over the place.
I would imagine if you're preparing for people getting ready to retire, once they retire, they might go to Florida or Colorado or somewhere.
Right. California, I have a client who spends half his time in Laguna Beach, California, and the other half in Lake Tahoe. So not a bad life.
Sounds like you did well by him.
Yeah.
So what would you say are some common hurdles that people face as they prepare for retirement?
So I teach a class on retirement planning at Penn State in Great Valley. I've been doing that this is the 6th year I've been teaching that. So it's an adult education class, and many people want to come in and meet with me afterwards and talk about their retirement. And most people have two primary concerns as they approach retirement. The main question that they want answered is, when can I retire? And the second part to that is, will my money last for the duration? People that have more money might articulate that differently. They might want to make sure that their lifestyle can be sustained for the remainder of their lives. But those are their two primary concerns. And a third one, which is more timely now, is you throw market risk in the mix, and that creates additional concerns. Mm-hmm. I was planning to retire in 2016. The market's volatile. Can I still retire when I want to? And so those are all sort of, create some anxiety around this transition from effectively an accumulation phase of life to a distribution phase of life. Mm-hmm. So the paycheck goes away. I've got to live on guaranteed sources of income like Social Security, and maybe if I have a pension, and the rest of it's coming from invested assets, and that can create a lot of anxiety.
Right.
I noticed that you said you're a registered investment advisor, but not a broker. What's the difference between the two?
Well, the two, there are some primary differences. One, they're regulated differently. Registered investment advisor is someone that gets paid for their advice, so they're not getting paid commissions to place financial products. And there's a number of ways that they can get paid for their advice. They can charge investment advisory fees for assets under management. They can charge financial planning fees. They can charge fixed fees or hourly rates or anything like that. A registered investment advisor has a fiduciary responsibility, so they act as a fiduciary for their clients, which means that they have to always do what's in the client's best interest. A broker is someone who's technically called a registered rep. They're affiliated with a broker-dealer, and they effectively get paid to sell a financial product. They get paid commissions for stocks, bonds, mutual funds, could be a variable annuity or alternative investments, and they have a different threshold to meet, and that is a suitability standard, which basically means that a broker, when they make recommendations, they have to be suitable for the client, for what they know about the client. And if product A pays double what product B pays, and they're both suitable, then they can recommend product A and get paid more because they've met that suitability standard. So it's just a different threshold to meet. So one gets paid to sell a product, one gets paid for their advice.
Interesting.
Do you find your clients prefer that structure that you just outlined?
I think there's a lot of murkiness in the financial realm that as advisors we understand it, but the general public has no idea how people get paid.
Right.
And what might be driving their recommendations. And I've been licensed over the years as an investment advisor, as a registered rep with an insurance license. And so I've been licensed to do all these things. And one of the reasons we decided to move into a fee-only world was I felt like if I was getting paid something up front to move money from this place to that place, there's no way I could be completely objective in that recommendation as hard as I tried. So there's just some inherent conflicts of interest. And the lack of transparency, I think, in the brokerage world just makes it hard for the general public to understand what's the motivation for this advisor's recommendation to me.
Yeah.
And so we try to make it very clear so they know how we get paid. Every quarterly statement has a fee statement on there so they know, what we're doing, and we have that responsibility.
So it's not like you're getting paid by the mutual fund company and charging your client. I think your observation that it's very murky out there for the average person, because there could be what would have been considered a large wirehouse, and they have investment advisory businesses, and the advisor may be paid extra to promote one type of fund versus another,
right?
And that may not be apparent to the client. So I think being a fee only, and you're fee only as well, right?
Largely
fee. Then they know that there's no particular incentive for you to promote one thing over another because you're being compensated somewhere that they may not be aware of.
Right.
And what's interesting is I think the industry has come a long way. If we look back over 15, 20 years and beyond to where we are today, it's really changed. And what I was thinking in listening to you, Charlie, is disclosure.
Right.
It's make your clients aware what are the fees.
Right.
And what are they paying for what service?
Right.
And that's a very legitimate question today for clients to ask.
Right.
Or prospective clients.
And I think in the investment advisory world, because of that fiduciary standard, you have a responsibility for that disclosure. And in the brokerage world, you really don't. And one of the things that's going on now with the Department of Labor is that Obama wants to basically eliminate any kind of broker-sold products with commissions inside a qualified retirement plan or even individual retirement accounts, so that if you're a broker selling annuities in an IRA and getting paid a commission, they want to do away with that, so that everybody in that world has to be a fiduciary. And it's under consideration now. I don't know how it's going to work out. So there's pressure coming down on this disclosure issue, and people want to know. And I've seen that just in terms of the feedback that I get from people coming to the class.
You'd mentioned earlier the concerns that people entering retirement have. What's the greatest concern they have, and how do you help them with that?
Well, the biggest concern, I think, is running out of money. People don't want to run out of money at any point in their lifetime, or they want to make sure they can sustain the same type of lifestyle that they've become accustomed to. And so my view on that is, while we can't predict the future of what the market's going to do, what inflation rates are going to be, what life might throw their way that they're not expecting, we can look at where they are today and what they're doing, how they're invested, what's an assumed rate of return on invested assets, what's an assumed inflation rate, how much money are they saving, what are their expense needs in retirement, what's Social Security going to be, and sort of look holistically at their financial picture. And then we use something called Monte Carlo simulation, which is just a statistical way of looking at variable results. And the way it works is the tool will vary the historical returns. It'll look back about 30 years, and based on your allocation today, it'll vary it 1,000 different ways so that it comes up with a range of returns based on whatever the sequence of those variances are.
Right, so it gives you a confidence interval of what, 90% probability?
Right, so what's the probability of making it through retirement without running out of money? And I find that much better in terms of looking at this, because we can look at, okay, worst case scenario, if you get dealt a really bad sequence of returns based on 30 years of history, then will you still make it through or not? As opposed to saying, if we average 6% a year, everything's going to be great.
Right.
And, to take that static 6% a year and run that out over 30 years, most things look pretty good.
Right.
But averaging 6 could look very different depending on, do you have good returns in the beginning or do you have bad returns in the beginning? So it's important to look at that sequence and to just come up with ways to try to help them feel confident about moving forward through that transition process.
So taking that a step further and tying back to what David and I started talking about insofar as volatility and market risk,
Right.
how do you manage risk with clients' expectations?
Well, so there's a few ways to deal with investment risk. One is you can avoid it. So I'm going to put my money in the bank and I'm not going to make anything on it, but I'm not technically losing anything. And we would know on a real return you're losing because inflation and taxes is going to erode that.
Sounds like a dangerous proposition.
You could accept the return the risk and say, okay, I know stocks are going to be risky, so I'm only going to allocate 50% of my money to stocks at all times. You could transfer the risk. So you could say, you know what, I'm going to put the money in a variable annuity and I'm going to have some guarantees associated with that. There's going to be costs for that product over and above what just in normal investing would be, but it's worth it to me to transfer that risk to the insurance company. Or you can manage that risk. And what we do is we manage the risk. Now, there's a couple of different ways to manage that risk. What I think most of Wall Street does is manages that risk based on what's called modern portfolio theory, which is academic theory, and they look at risk in terms of what's called standard deviation, which is volatility or the variance of return. And the theory says that if we can reduce the variance of return, then we've reduced the risk of the portfolio. But the problem with that is that it does nothing to help in a down market. So market risk is non-diversifiable risk. The best diversified portfolio in the world is going to lose money in a down market because they're going to all fall at about the same rate, and so it doesn't help protect capital.
Like it used to be years ago that you would invest in emerging markets, large cap, small cap, REITs, and this whole mix, and they were supposed to be uncorrelated with each other.
Right.
But I think what you were just saying is that when everything is collapsing all at once, they all go to a one correlation.
Right. So in a rising market, they are somewhat uncorrelated.
Yeah.
And if you looked at from 2003 to the peak in 07, emerging markets, probably the best performing asset class, great performance over and above the S&P, so it helped to have that non-correlated return. From 08 through the bottom in March of 09, the correlation came together and everything fell at about the same rate. Mm-hmm. So using academic theory, while it works in some cases, it doesn't work when people need it to work, which is in retirement when you're going through a bear market. So my view is that the only real way to deal with that risk is to, at times, avoid it, to avoid risky assets. And so that means then you have to have some process for identifying what kind of environment are we in, and is this an environment where we want to take risk or where we want to dial risk down, and you have to have a way of figuring that out and then executing that.
How do you do that?
Well, so we use technical analysis to do that, and primarily it's based on something called relative strength, which is comparing the price change of one security or index to the price change of another security or index. So we compare a number of different things to each other to determine where the strength is in the market. And recently we've seen some major changes in those dynamics. And it's basically been a change from risky assets being in leadership, primarily U.S. equities, to them losing steam to more conservative asset classes like bonds and cash. And one of the comparisons we make is the S&P index compared head-to-head with the Barclays Aggregate Bond Index. So a broad stock market index, a broad bond market index, and in February that switched from stocks being in favor to bonds being in favor. The last time we saw that happen using this comparison was in June of 2008, and the time before that was in November of 2000.
So that would indicate that we could be liable for, theoretically, a period of decline.
Right.
Yeah.
Yeah, and if you look at, you mentioned some interesting things about bear markets and how many there were, and what the long-term return for the U.S. stock market was, and over a long period of time, that's great. But there have been long periods of time in between that where from the 60s through the 70s to 82, we had a very difficult market.
Right.
You had 82 to 2000 straight up market. What works in that environment doesn't necessarily work from 2000 to 2010, where you had two severe downturns, lots of volatility, no returns. And if you retire in 82, you're going to do fine, because the market's rising tide is going to lift all boats. If you retire in 1999, you've got a tough row ahead of you.
Yeah.
And so, I believe that we're in a longer term bear market cycle, and that this is just another downturn that we're going to experience before getting to what's called a secular bull market.
So here's a question which ties into our audience, I believe. We understand this, and certain number of people, and call it our clients, are going to understand that. But what I'm leading up to is managing client expectations.
Right.
So if you get into I would think getting into too much technical analysis, mean variance, standard deviation, use some of those terms with clients, not how many of them understand it, but how do you manage their expectations to help them achieve their goals?
So our goal, our objective of our process is to make money when the market's doing well and protect capital when the market's not doing well. So when we're in a long-term positive trending environment, our goal is to make money. When it's in a long-term negative environment, to protect capital.
When did you go long into the market? After the June of 08, where you cut back? When was the
So
signal to go
I
back in?
believe in June of 09 was when things switched back. So a little bit lagged from the bottom was March. I believe today is the anniversary of the bottom in 09.
Yeah.
Now, that trend started then. 2011 was a little tiny head fake, kind of a reversal in August of 2011. In October of 2011 started another stocks in a positive trending environment, and overweight U.S. stocks worked very well from October of 2011 until just recently. So, we just educate them on what our process is.
Right.
We don't get down into the weeds, because you're right, they don't want to know all the technical details. Basically, they want to know, do you have a process for managing my wealth so that I can do the things that I want to do and live the life I want to live?
Right.
And that's our goal. And so we deliver that to them by educating them on what's going on, how we're adapting to it, and we use the Monte Carlo. So one thing we've been doing a lot of lately, people come in for reviews and we rerun the Monte Carlo, when we say, okay, well, you're down X% off the high, and everybody's down something off the high of last year. And don't worry about it, because it hasn't changed the long-term probability of success for your retirement plan. So while we can't predict what the future is, we can use these tools to help people stay on track. And the whole idea is to bring a sense of peace about it, so that they can be free to do the things that they love to do that really brings their life meaning and purpose, and knowing that we're going to take care of things and adapt to changing conditions.
Perfect place to put a lid on things. We've wound down our time. Very good information and insight, Charlie. Thank you very much.
Thanks for having me.
Our guest next week is Valentin Radu, who's the conductor for Vox Amadeus in Philadelphia. So please tune in for the next show. And until then, your money matters to us.